Nifty almost touched 20,000 and we're all wondering whether it will cross the 20,000 mark or will reach to as new heights as 21,000. So here is this one question that I am willing to answer in this particular video, whether Nifty would cross that threshold of 20,000 and touch 21,000 or 22,000. So to answer this question, I've coupled down a few indicators through which we'll understand whether Nifty will go at that level, and at the very same time, if it does, what all sectors would be the biggest contributor. Alright, so let's begin. The first indicator that I'm going to discuss is the Buffett indicator. So Buffett indicator is something that is very interesting. So what it does is it compares the market capitalization of all the publicly listed companies in India divided by the GDP of the country. So say for example, today we have somewhere about 4,000 to 5,000 publicly listed companies. You add up all the market capitalization of all these companies, that makes the numerator of the Buffett indicator, and at the very same time you have the GDP of the economy, that makes the denominator of it. So the idea is very simple. Like every other indicator, what you do here is you calculate the average of the past 10 years, 15 years, 20 years and see where exactly this number is currently. So say for example, in the past 10 years, the average has been somewhere about 120. Now, if the current Buffett indicator is beyond this number, say for example it is 140, 180, 200, then we say that the markets are overvalued because the numerator number has to be high for the fraction to be bigger. And in that case, we can say that the markets are tending towards that overvalued zone. Likewise, if again the average of the last 10 years is around 120%, 130% and the current value is around 70-80%, so we can easily say that according to the Buffett indicator, the market has started to move in that undervalued zone. So what I'll do is I'll take the graph of the Buffett indicator for the Indian markets and we'll see how the Buffett indicator has fared out in the past, how has the average been for the last 15 years, 20 years, and what is the current Buffett indicator value. So the idea is very simple. You have this entire data set. As you can see, the average is nothing but 82.93, and goes without saying, as the market capitalization moves, you will also see the Buffett indicator moving, and likewise as the GDP of the economy grows or shrinks, you'll see that impact coming on the Buffett indicator as well. So we can see that the average line is 82.93. Alright, in the past, the Buffett indicator has gone to as high as 158. This was a scenario when we were into the financial bubble of 2008. So that had happened back then. Goes without saying, the Buffett indicator was screaming out loud and telling that the markets are overvalued and we should be selling it. And that exact same thing happened. The bubble bursted and the market capitalization came down crashing. But then again, once the crash happened, the Buffett indicator went below 60, which is way lesser than the average. At that point in time, the markets were able to give us an opportunity to buy in and make some returns out of it. Alright, now let's see the current scenario, how exactly it is. So whenever I put across the Buffett indicator, I always tell people that you have the average line, and whenever you want to figure out whether the markets are overvalued or undervalued, look at the +1 and the -1 standard deviation zone. So here the +1 standard deviation zone is somewhere above 100, as you can see with this line, and likewise the -1 standard deviation zone is somewhere about 60. So what I feel is that if the markets are in this range of 60 to 110, 100, in this particular range, we can say that the markets are not overvalued and they are, in a good fair valued zone, and we can easily buy the markets in this particular range because the GDP is performing well, and at the very same time, the Buffett indicator is indicating us that the markets have not entered the overvalue zone. The problem lies into situations like 2008 crisis, when the number goes beyond 2 standard deviations, 3 standard deviations, and all those things happen. So that is one thing that I would like you to understand, one of the important things about the Buffett indicator. At the very same time, you also need to look at how future earnings or the future GDP is looking like for the economy. So given that the future GDP, the numbers, the forecasted numbers, they seem to be good, in that case, what will happen here is, for the entire Buffett indicator, the GDP will go up, that is the denominator will go up. And once the denominator goes up, it will bring down the fraction. So, but naturally, given that people start earning more, the economy starts doing well, automatically the market cap would also start to rise. Alright, so that is also a very positive indicator in terms of how the future of the economy looks like and what kind of impact it will have on the stock market. Alright, so this was one of the indicator, very simple, very easy to understand. The next indicator which I generally discuss is the PE multiple. Alright, how you know about the PE multiple for individual companies, likewise you can evaluate the PE multiple for the markets as well. So to give you a brief for those who do not understand what exactly PE multiple is, it's a very simple concept. You have the price of the company or of the index in the numerator, and then in the denominator you have the earnings per share. Alright, so say for example you're talking about a company like Reliance. So you have the price of 2500 in the numerator, and in the denominator you have the earnings per share of Reliance. Alright, so that is how you calculate the PE multiple. What it implies here is that how much price are you paying to buy that 1 rupee of earnings for that company. So say for example, the PE multiple of Maruti is 20x. So in that case, you're willing to pay Maruti Suzuki a price of 20 rupees to earn that 1 rupee of earnings. Alright. Now likewise, say for example, the PE multiple of Tata Motors is 45. In that case, you're willing to pay 45 rupees to Tata Motors to earn that 1 rupee of earnings of Tata Motors. The reason why you're willing to pay a higher price to Tata Motors is because it might be futuristic in nature, it has done a decent job in the EV space and all those things. That is applicable for companies. But when we look at PE multiple from a broader angle, generally the lower the PE, the better it is in terms of valuations, that yes, we are paying a lesser amount to a particular company or an index to get that 1 rupee of earnings. Now let's look at how the PE multiple of the Nifty Index has fared out in the past 23 years. Alright, we have the entire data set of the past 23 years in the Excel file. Alright, we have the data set for every month. So we have the PE average for January 2000 till June, July 2023. Alright, so we have all these numbers. We have all the averages as well calculated for all these years. So we have the average for 2000, we have the average for 2001, 2002, so on and so forth. Alright, now one thing that I would like you to notice here is if I calculate the average for all the past 23 years on a monthly basis based on what the PE has been, I can see the average of the PE multiple has been somewhere about 21, which I could consider as normal because we have considered a very long time period. Now we need to do what here? We need to compare this average multiple, average PE multiple to that of the existing multiple. Again, the logic is completely the same how we applied it for Buffett indicator. Here again, you need to compare the average with that of the existing multiple. So say for example in June 2023, that is as recent as 1 month, the PE multiple was somewhere about 21. Alright, again the average has been somewhere very close to 21 and the PE multiple has also been around 21. So we can easily say that we are almost at par the average. So that's a very good sign for the markets, because here on an average basis we are saying that we're willing to pay around 21 rupees to the Nifty Index to get that 1 rupee of earnings of all the 50 companies combined that are there in the Nifty Index. And at this point in time as well, the valuations are exactly the same, where we are willing to pay that 21-22 rupees to get that 1 rupee of earnings of the Nifty Index. So we are almost at par in terms of valuations. Now since the economy and everything is doing better, we'll be moving ahead in terms of the earnings that these corporates will generate. So say for example, if you look at the past quarter data, or if you're looking at the future commentary of the management, you are listening that the numbers or the earnings of the companies will do better. Now, given that the earnings do better, what will happen to the PE ratio? The earnings would rise. That is, the denominator would rise. And once the denominator rises, the entire fraction comes down. So it becomes more favorable for us to buy the markets. And that is something that will play a very important role, and it's very expected that the companies are going to do well in the near future. So automatically the PE multiple comes down. Now again, for the PE multiple to come back to its average, what we need to do here? We need to increase the prices. That is how the PE multiple will go up. And once we increase the prices, automatically Nifty might move towards 20,000, 21,000 range in the next 6 months, 8 months, 1 year's time frame. So that is something that we need to address, looking at how the valuations of the companies are. Now, given that things work out very well and the economy and the companies do very well, we need to identify that in this entire bull run, if it comes in, what all sectors would perform or outperform the other sectors. Alright, as we know in the Nifty Index, we have somewhere about 13 sectors. Now there's a way how we can tell that which of the sector will perform well or will outperform the other sectors whenever there is a bull run happening, or whenever there is a consolidation happening or a bear run happening, which sector would do better compared to others. So there is a very simple way to do it, that is through ratio analysis. So we are going towards the technical side of things here, where we'll understand how ratio analysis work out. So on our screen we have the ratio chart of Nifty IT and the Nifty Index. So what ratio charts do here is they basically have an index of a sector in the numerator and they have the entire index in the denominator. Alright, you can do it for Nifty IT versus Nifty, you can do it for Nifty Bank versus Nifty, you can do it for Nifty Pharma versus Nifty. Nifty. You can also do it inter-sector basis. That is, you can have Nifty IT in the numerator, you can have Nifty Pharma in the denominator, and see how the ratio charts are working out. So what exactly the notion of this ratio analysis is to figure out whether there will be an outperformance in the Nifty IT sector or not. Now let's see how it works out. So we have the data set of the last 6 years, 7 years here of the Nifty IT to Nifty ratio chart. You can see that marked by the red line here. Alright, and we have the values of the Nifty Index here. Now in this entire phase, alright, in this entire phase of 3 years, we can see that the Nifty IT index did not move by much. And at the very same time, you can look at the ratio chart as well. You know, the ratio chart was almost below the breakout line. It did not cross the breakout line even once. So that is something that you can look at. And once that outperformance started to come in, that was I think back in 2020, once that outperformance started to come in, what really happened here is the outperformance could easily be seen on the ratio chart as the ratio chart went up. Alright, and mind you, if the ratio chart is going up, what it means here is that Nifty IT, which is the numerator of this entire fraction, is moving much faster than the Nifty index. So that is why this ratio chart is going up. That is why the ratio numbers are going beyond this particular threshold line. And once this moves very fast, we can easily say that this particular sector has become the leader of this bull run, and this particular sector is making sure that, you know, the Nifty itself goes up. So that is something that you can look at. Now you can make a comparison of Nifty Bank with Nifty as well, and you can mark it on the ratio chart and see how things are. If it is below the threshold line and still the Nifty index in itself is moving up very fast, you can assume that the Nifty Bank is moving either at par the Nifty index or below the Nifty index. So that is something that you can make out very easily. You simply have to divide these two numbers and you get a very good idea in terms of how that particular sector will outperform the entire index or not. Likewise, you can, you know, since markets are rising and since we are tending towards a bull run, you can easily deploy these charts and figure out what exact index might give a better return vis-a-vis others. Because in mega bull runs, 8 out of 10 sectors tend to perform well, but you need to identify which particular sector will outperform the other. There's one very interesting quote that Naresh, you know, pitches in his courses at Upsurge is तेजी में इतना लूट लो कि मंदी से फर्क ना पड़े. So this exact same thing of outperformance will help you out to make the most out of bull runs, and this will ensure that the bear runs do not really impact your portfolio much or do not really impact your returns by much. So I'm hoping you have understood what exactly we have discussed here. You can do your analysis based on these 2 to 3 parameters and look at how the Nifty index might move in the times to come. Thank you.